Welcome to the deep dive. We've got a really interesting set of sources today, all about building your financial nest, specifically looking at protecting your savings and understanding, well, a pretty powerful financial tool. And this is really for you if you're looking for maybe a beginner's guide. You want to get up to speed quickly, find those aha moments, but, without feeling totally swamped.
Yeah, and what's really interesting is how these sources tie together two things that seem separate but are, well, they're both vital for personal finance. You've got the challenge of inflation on one side,
Right.
and then this opportunity presented by health savings accounts, HSAs, on the other.
Exactly. So our mission today, let's unpack what inflation actually is, why it's such a headache for your savings. Then we'll look at some real strategies the sources suggest to fight back. And after that, a deep dive into HSAs. What are they? How do they work? What are the big benefits? And how can you use them strategically? Not just for doctor bills, but maybe for long-term saving too.
It's really about getting your money to work harder for you, especially when you've got things like rising prices happening all around.
Okay, let's get into this source material and see what nuggets we can find for you. All right, first up, inflation. We all hear that word, but these sources call it a silent, persistent force. Sounds a bit dramatic, but what does it actually do to our savings?
Well, basically, it just means the general cost of things, goods, services, it steadily goes up over time. So the money you have saved, it buys less in the future. Your purchasing power, it drops.
Like that coffee example they used. A $3 coffee last year's $3.09 this year with 3% inflation. Seems like pennies, right?
It does seem small, but imagine that happening across, well, everything you buy, and then compound that year after year. It really adds up.
Okay.
And they measure this using price indexes. You've probably heard of the CPI, the Consumer Price Index. That tracks average price changes for a whole basket of stuff: food, gas, housing, you name it. So when you hear inflation is 3%, often that's the CPI change they're talking about.
Got it. But why is this such a big deal for savings? If I have $100, it's still $100, isn't it?
Ah, that's a really important question. The number stays the same, yes. But the value, what that $100 can actually buy, that's going down. If your savings aren't growing at least as fast as inflation, you're effectively losing money in terms of what it can buy.
So that $1,000 you saved might only get you $970 worth of stuff next year if inflation's 3%.
Exactly. And think about that over 10, 20, 30 years, it becomes a really significant erosion of your wealth.
Which means just leaving money in a standard savings account, or worse, just as cash. That's particularly bad.
Absolutely. Those basic accounts, they pay very little interest, usually much less than inflation. So the real value of your money is shrinking year after year. It feels safe, maybe, because the balance doesn't go down, but your purchasing power is definitely taking a hit.
Wow, okay. That really shifts the perspective. And how does this hit long-term goals, like retirement? They had that striking example, something costing $100 today.
Yeah, it could cost around $242 in 30 years, assuming like a steady 3% inflation.
That's more than double.
It is. And that's the core problem for long-term planning. Your savings need to grow quite a bit just to keep pace with rising costs. That's before you even think about actually increasing your wealth or having a better standard of living later on. High inflation makes planning tough, and yeah, it can even discourage people from saving altogether sometimes. Feels like you're running just to stand still.
Okay, so inflation is definitely something we need a strategy for. What do the sources suggest? How do we protect our savings? Get them growing faster than prices?
Well, the fundamental idea seems to be shifting from just saving cash to investing it. Investing always has risks, that's true. But the sources kind of imply that non-investing, especially when inflation is high, is also a losing game. You're pretty much guaranteed to lose purchasing power.
Right, so first up, they mentioned investing in stocks or equities for long-term growth.
Yeah, historically, looking over long periods, the stock market has tended to outperform inflation. Think about it. Companies can often raise their prices when costs go up, which can boost their revenues and profits, and hopefully drive up their stock prices and the dividends they pay out.
But stocks feel volatile, the ups and downs, especially if you're just starting.
Oh, definitely. Short-term volatility is absolutely part of the package. That's why it's usually recommended for long-term goals. We're talking 5, 10 years or more, ideally. That gives your money time to recover from any dips along the way.
Okay.
And diversification is key. The sources really stress this for beginners. So instead of picking individual stocks, maybe look at low-cost index funds or ETFs.
Like an S&P 500 fund?
Exactly. That spreads your money across hundreds of companies, so you're not overly exposed to any single one failing. Dividend stocks are also mentioned as another cushion.
Makes sense. Don't put all your eggs in one basket. What about bonds? I always thought bonds were the safe investment.
Well, traditional bonds, like, say, corporate bonds or standard government bonds, they do offer more stability than stocks generally. But the problem is they usually pay a fixed interest rate. And when inflation goes up, the purchasing power of those fixed payments goes down. And another thing, when inflation pushes interest rates higher overall, the price of existing bonds with lower rates tends to fall. So they aren't really a direct inflation hedge by themselves.
Okay, so not perfect for inflation.
But the sources highlight two specific kinds of government bonds designed precisely for this. Treasury inflation-protected securities, TPS, and Series I savings bonds, or I bonds.
Okay, TPS and I bonds, how are they different?
So with TPS, the actual principal value of the bond gets adjusted based on inflation, the CPI. So as prices rise, the value of your bond rises and the interest payments rise too.
Oh, interesting.
And I bonds, they earn interest in two parts. There's a fixed rate, set when you buy it, plus an inflation rate that changes twice a year based on the CPI. Both are backed by the US government, so they're considered very safe from default. There's specific tools designed to help your money keep pace, or maybe even beat inflation.
That's really useful to know, specific tools for the job. What about real estate? Is that an inflation hedge?
It can be, yeah. Real estate is a tangible asset, right? Physical property. Historically, property values have often appreciated faster than inflation over the long haul. Part of that is because construction costs go up with inflation. And if you own rental properties, you can often increase rents over time, too.
But buying property directly, that's a huge commitment, right? Big down payment, ongoing costs, maintenance, and it's not exactly liquid. You can't sell it overnight if you need the cash.
Very true. It's not for everyone. The sources mention REITs, real estate investment trusts, as a way around that.
REITs, like a mutual fund for property.
Kind of, yeah. You buy shares in companies that own and operate properties that generate income: shopping malls, apartments, office buildings, etc. It gives you diversification, a much lower entry cost, and you can buy and sell shares easily, like stocks, more liquid. But of course, real estate still depends heavily on location and market cycles.
Gotcha. They also briefly mentioned commodities, like gold, but sounded a bit wary.
Yeah, the idea is that raw materials, their prices should rise with inflation. Gold's often seen as that classic store of value when things get uncertain. But commodity prices, they are extremely volatile. And they're influenced by way more than just inflation. Think global supply, demand, politics, speculation.
So risky.
Very. Direct investment is complex. Even using ETFs, the sources seem to say, look, this is speculative. If you do it at all, keep it a really small part of your portfolio, maybe 5% or less. Not a core strategy for beginners usually, because they don't generate income and are so unpredictable.
Okay. And what about just putting money in a high-yield savings account, an HYSA?
Yeah.
They pay more interest than my regular bank account.
HYSAs are great. They're excellent for safety, for keeping your money accessible liquid. And yes, they definitely earn more interest than a basic savings account.
Right.
But the sources are pretty clear. Even with those higher yields, they often still don't earn enough interest to actually beat moderate or high inflation, especially once you factor in taxes on the interest.
Oh, taxes. Really.
So their main job isn't really aggressive growth to outpace inflation. It's about preserving your capital and keeping it easy to get to. Perfect for your emergency fund or saving for a short-term goal where you absolutely can't risk losing principal. Safety first, not maximum growth.
Okay, so beating inflation long-term likely means looking at things like stocks or those specific bonds, TPS and I bonds.
Yeah.
HYSAs are for the safety net. What about earning more money? Is that part of the picture?
Absolutely. The sources mention this as a really powerful proactive strategy. If your income grows faster than inflation, you just have more breathing room, more money to cover rising costs, and more money left over to save and invest more aggressively.
How do you do that?
Well, they suggest things like negotiating raises, developing skills that are in high demand, maybe starting a side hustle or freelancing, pushing for career advancement, or even starting your own business. Anything to boost your earning power.
That makes a lot of sense. Attack it from both ends, make your savings grow, and bring more income in. The sources also mention something called real returns. That sounds important.
It's crucial for knowing if you're actually winning against inflation. See, the nominal return, that's just the percentage gain you see on paper. Your investment went up 7%, say.
Okay.
But the real return, that's your gain after you subtract the impact of inflation. So roughly, nominal return minus the inflation rate.
So if I earned 7% and inflation was 3%.
Your real return is about 4%.
Yeah.
Your purchasing power actually grew, but if your savings account earned only 1% interest and inflation was 3%.
Minus 2%.
Exactly. Your real return is negative. You earned interest, but you still lost purchasing power because prices rose faster. Focusing on that real return tells you if your strategy is actually working.
That's a really clear way to think about it. And aside from investing, were there any, practical day-to-day tips for managing during inflationary times?
Oh yes, definitely. Budgeting becomes even more critical. You need to track exactly where your money is going and where those price hikes are hitting you hardest. They suggest things like cutting back on discretionary spending, the wants, not the needs. Becoming a bit of a bill negotiator, call your cable company, your phone provider. Ask for a better rate.
Worth a try.
Absolutely. Shopping smarter, too. Compare prices, use coupons, maybe try generic brands, buy sensible things in bulk if it saves money, maybe delay big non-essential purchases if you can.
Like maybe wait on that new TV.
Exactly. Optimize energy use at home, review all those subscriptions you might have forgotten about. It's all about freeing up cash that can then be used to save more or invest. Being really intentional with your spending.
Okay, so we've covered inflation, the silent threat, and a bunch of strategies from the sources to fight back. But then the sources shift focus to a specific tool, health savings accounts, HSAs. They call it one of those most powerful and versatile tax-advantaged accounts out there, if you qualify. That sounds promising.
They really are quite unique. An HSA is basically a savings and investment account, but it's got special tax breaks, and it's specifically for people covered by a qualifying high-deductible health plan and HDHP. It's like a hybrid. You can use it for current medical bills, but also let it grow for the long term, like an investment account.
Okay, so the absolute first thing, the gatekeeper, is you must have that specific type of health insurance, an HDHP.
Yes, that's the non-negotiable starting point. Your health plan has to meet specific IRS criteria for minimum deductibles and maximum out-of-pocket costs. These numbers change slightly each year, so you need to check.
And you can't have other conflicting insurance.
Generally, no. You usually can't be covered by another health plan that's not an HDHP, though things like separate dental or vision plans are usually okay. Also, you can't be enrolled in Medicare, any part of it, and you can't be claimed as a dependent on someone else's tax return. So checking those eligibility rules for the current year is absolutely step one.
Got it. HDHP is key. So let's say you have one. How do you actually get an HSA? Does it come with the insurance?
No, it's a separate account you have to open yourself. Your employer might offer one, maybe through a preferred provider, but you often have the choice to open one elsewhere at a bank, a credit union, a brokerage firm.
Oh, so you can shop around.
Exactly. You can compare fees, investment options, things like that. It gives you more control.
Okay, so you open the account, then you put money in. How does that work with taxes? That seems to be a big deal here.
It is. This is where one of the big advantages kicks in. If your employer offers it, you can contribute through payroll deductions, and that money comes out before taxes. Not just federal income tax, but also Social Security and Medicare taxes, FICA taxes. That's a huge upfront saving.
Wow, avoids FICA too.
Yep. Or if you contribute directly, say transfer money from your bank account, you can deduct those contributions on your federal tax return. That lowers your taxable income. There are annual limits on how much you can contribute set by the IRS. They usually go up a bit each year for inflation. And there's an extra catch-up amount you can add if you're 55 or older.
Okay, so money goes in with a tax break. Then you can use it for medical stuff, tax-free.
Exactly right. You can withdraw the money completely tax-free as long as you use it for qualified medical expenses. And the list is really broad: doctor visits, prescriptions, even many over-the-counter meds now. Dental, vision, hospital bills, physical therapy, medical equipment, transportation for care. It covers a lot for you, your spouse, and your dependents.
Even if they aren't on my HDHP.
Even if they aren't on your HDHP. The sources definitely stress keeping good records, though. Save those receipts. IRS Publication 502 has the full list.
Okay, keep receipts, and crucially, unlike those flexible spending accounts, FSAs, where you have to use the money within the year, HSA funds roll over.
Yes, that's massive for the long-term potential. Any money you don't spend just stays in the account and keeps growing year after year. No use it or lose it deadline. Plus, the account is yours. It's portable. If you change jobs, change health insurance, the HSA money is still yours. You just can only contribute new money in years you're covered by an HDHP.
That rollover feature seems key to the next part, the investment side. The sources say this is where the HSA truly shines.
It really is. Most HSA providers will let you invest the money in your account, usually once you have a certain minimum amount, like maybe $1,000 or $2,000 kept in cash for immediate needs. This ability to invest is what turns it from just a healthcare spending account into a potentially powerful long-term wealth-building tool. Imagine decades of investment growth happening entirely tax-free.
Okay, that leads right into this triple tax advantage they talk about. Can you break that down? Why is that combo so special?
You bet. It's unique because no other common account really combines these three things in exactly the same way. 1, contributions go in tax-advantaged, either pre-tax from your paycheck, saving income, and FICA taxes, or tax-deductible if you contribute directly. Big upfront savings.
Okay, tax break going in.
2, the money grows completely tax-free. Interest, dividends, capital gains from your investments, no taxes due on that growth year after year.
Tax-free growth, nice.
3, withdrawals are completely tax-free as long as they're used for those qualified medical expenses, now or 20 years from now or in retirement.
So tax-free in, tax-free gross, and tax-free out for medical.
Right.
Wow, how does that compare to, say, a traditional IRA or a Roth IRA? People might have heard of those.
Yeah, it's a good comparison. With a traditional IRA or 401k, you often get a tax deduction upfront, and growth is tax-deferred, but then your withdrawals in retirement are taxed as income. With a Roth IRA or Roth 401k, you contribute money you've already paid taxes on, but then the growth and qualified withdrawals in retirement are tax-free.
Okay.
The HSA, when used for healthcare costs, kind of takes the best of both. You get the upfront tax break, potentially even better than a traditional IRA because of the FICA savings, plus tax-free growth like a Roth, plus tax-free withdrawals for qualified expenses. It's a really potent combination.
That does sound powerful. And they mentioned using it in retirement, even called it a stealth or secret retirement account. How does that angle work?
Right, so after you turn 65, the rules get a bit more flexible. You can still pull money out tax-free for qualified medical expenses. And remember, things like Medicare premiums count as qualified expenses then, which is huge.
Okay, still tax-free for medical.
But the changes after 65, if you need to take money out for non-medical reasons, maybe travel or just living expenses, you can. You'll pay ordinary income tax on those non-medical withdrawals, just like you would from a traditional IRA.
But no penalty.
Exactly. That steep 20% penalty for non-qualified withdrawals, that disappears at age 65. So it essentially becomes like a traditional IRA for non-medical spending while keeping its super tax-free status for medical spending.
Makes it incredibly flexible in retirement.
Very interesting. What about that pay-yourself-back strategy they mentioned? Sounds a bit complex.
It's definitely an advanced move, requires serious discipline. But the idea is, you have a qualified medical expense today, let's say $500. You pay it out of your regular checking account, not your HSA.
Okay, out of pocket.
Then you save that receipt. Like really save it, scan it, file it, whatever. Years later, maybe decades later, your HSA investments have hopefully grown nicely. You can then reimburse yourself from your HSA for that past $500 expense. And because it was a qualified medical expense, that $500 withdrawal comes out completely tax-free. So you're essentially pulling out investment gains tax-free, up to the amount of your documented past expenses.
Precisely.
Yeah.
But again, you absolutely need bulletproof records of those past expenses you paid out of pocket. It's not for the disorganized.
Definitely sounds like it requires organization.
Yeah.
What are the downsides or things to watch out for with HSAs?
Well, the biggest hurdle is needing that qualifying HDHP to contribute in the first place. And HDHPs mean, by definition, higher deductibles. So you could face significant out-of-pocket costs for healthcare before your insurance really kicks in much. You need to be financially prepared for that possibility.
Good point. Need cash flow for the deductible.
Right. Also, the annual contribution limits, you can't just put unlimited money in.
No.
And that 20% penalty plus income tax on non-qualified withdrawals before age 65 is harsh. You don't want to accidentally trigger that. And yeah, it takes some management, choosing investments, keeping records, especially for reimbursement, and watch out for fees.
Fees. Like bank fees.
Yeah, some HSA providers charge monthly maintenance fees, some charge fees for investing, like expense ratios on mutual funds or ETFs, maybe transaction fees. You really need to compare providers. State taxes can sometimes differ too, though most states follow the federal rules. Worth a quick check.
So if you are eligible with an HDHP, how do you pick a good HSA provider, especially if you want to invest?
If investing is your main goal, fees are probably number one. Look for low, or ideally zero, monthly maintenance fees. Check the investment fees you want access to low-cost, diversified index funds, or ETFs. See if there are fees to buy or sell investments. Also, look at the investment options themselves. Do they have the funds you actually want? What's the interest rate on the cash portion?
Oh.
Is there a minimum balance you need before you can start investing? Lower is better. And then just practical stuff. Is the website or app easy to use? Good customer service? Is the cash portion FDIC or NCUA insured? The sources mentioned Fidelity and Lively as examples of providers often liked for low fees and good investment options.
All right, so summing up the HSA part, who should really give this serious consideration if they have that qualifying health plan?
The sources seem to suggest it's particularly good for, say, relatively healthy people or families who might not hit their deductible. Often the lower HDHP premium lets them save more in the HSA, and more of it can be invested. Definitely good for long-term savers and investors who plan to pay current medical costs out of pocket if possible, treating the HSA like a supercharged retirement account.
The super IRA idea.
Exactly. Anyone looking to maximize tax savings, people planning ahead for healthcare costs in retirement, this is a huge potential benefit. High-income earners get more value from the tax deduction. And as we said, disciplined record keepers can use it most flexibly. It might be less ideal if you have very high, predictable medical costs every single year that always blow past the deductible. You'd be paying a lot out of pocket constantly with the HDHP.
Okay, so it's a fantastic tool, potentially, but you need the right circumstances, the HDHP, and a clear strategy for how you want to use it. So let's pull this all together. What does it mean for you? We've looked at inflation, that slow leak in your financial boat, and explored strategies from the sources to patch it up and maybe even sail faster. Things like investing in stocks for the long haul, using specific tools like TIPS and I-bonds, maybe real estate through REITs, using HYSAs for that crucial, safe, liquid cash.
And also that really proactive step of working to increase your income. Don't forget that one.
Right. And then we dove into health savings accounts. Understanding who's eligible, that HTHP requirement is key. How they work, that amazing triple tax advantage.
Yeah, and really seeing them not just as a way to pay for today's doctor bill, but as a potentially powerful long-term investment engine, especially for funding healthcare down the road in retirement, or even just as another tax-advantaged bucket for general retirement savings after 65. So I think the big takeaway here is that you can't really afford to ignore inflation. It's actively working against your savings if you do nothing. And if you are someone with a qualifying high-deductible health plan, the HSA offers this really unique, valuable opportunity for your long-term financial health that, according to these sources, you should really look into.
But it takes effort, right? Implementing these strategies needs diligence. You need discipline to stick with investments when the market gets rocky. You need meticulous records if you want to maximize that HSA reimbursement strategy later. And even just day to day, being more intentional with budgeting and spending when prices are rising.
Yeah, it's clear from all this that building that secure financial future, especially in today's world with inflation or making the most of something like an HSA, it's not passive. It requires you to be proactive, informed, and strategic with your money, even if you're just starting out.
And as the sources rightly point out, what's suitable really depends on your situation, your health needs, how comfortable you are with risk, your specific goals. So these are complex things, which leads to maybe a final question for you to think about. Given what we've discussed, the power of compound growth over decades, but also that constant erosion from inflation, where's your focus right now? Is it more on avoiding the short-term ups and downs, the volatility, or is it more on maximizing your long-term purchasing power, what your money can actually buy years or decades from now?
And definitely remember, the sources strongly suggest talking things over with qualified professionals. A tax advisor, maybe an insurance broker about HDHPs, a certified financial planner. They can help you figure out what makes sense for your specific circumstances before you make any big moves.
Great point. Thanks for joining us for this deep dive.